When most people think about the stock market, they picture an adrenaline-fueled casino. They treat investing like placing chips on a spinning roulette wheel, crossing their fingers and hoping for a lucky payout. That abstract idea is constantly reinforced by the physical reality of traditional finance. Look at the trading floor. It is loud, chaotic, and overwhelming, designed to make you feel like you have to move fast or get left behind. This environment breeds a fatal assumption among amateur speculators. They begin to believe that achieving massive financial rewards requires taking on equally massive, reckless risks. But this casino mentality entirely misses how the ultra-rich actually operate. Long-term wealth is never built by gambling. The greatest investor in modern history, Warren Buffett, reached billionaire status by prioritizing capital preservation over aggressive growth. His career is defined by a relentless focus on defense. His entire empire operates on a strict mathematical mandate. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is a rigid operational law. This chart shows the destructive math of losing capital. If your portfolio takes a 50% hit, a 50% gain does not fix it. You need a 100% upward climb strictly to return to your original starting line. And while you are spending years trying to claw your way back to zero, your compounding interest is irreparably damaged. The growth curve flattens out, making true financial recovery statistically improbable for the average investor. If the ultimate prerequisite for wealth is to systematically prevent loss in a volatile market, we have to look at the actual mechanisms used to lock that defense in place. The first mechanism of rule number 1 is entirely internal. It is a psychological filter designed to manage personal ignorance and block out the endless external noise of the market. Buffett calls this the Circle of Competence. It relies on the liberating concept that you do not need to understand every new tech IPO or crypto trend to be successful. This diagram visualizes how the circle operates. You map out the exact narrow boundaries of the industries and businesses you understand deeply. Then you fiercely ignore everything else. Maintaining this requires immense psychological discipline. When assets outside your circle are surging and generating hype, your defined boundary keeps you insulated from the noise. The moment you step outside that boundary to chase a trend you don't understand, you cease to be a calculated allocator of capital. You become a blind gambler. Risk is not inherently generated by the stock market itself. Risk is generated when you operate outside your own boundaries of understanding. But the Circle of Competence is not a perfect shield. Even when operating strictly within your expertise, human error happens, or the broader external market unexpectedly crashes. That introduces the second mechanism. This graph compares the actual worth of an asset with what you pay for it, illustrating the margin of safety. This rule requires purchasing an asset at a price significantly below its mathematically proven intrinsic value. This gap between the true value of the business and the heavily discounted price you paid creates a mathematical shock absorber for your portfolio. In a worst-case scenario where the company severely underperforms or the market tanks, the intrinsic value drops. But because your purchase price was heavily discounted, your principal investment remains protected. Compare that to buying an overhyped asset at a massive premium. With no buffer in place, even a tiny market correction instantly eats into your initial capital. The margin of safety is the ultimate fail-safe. It ensures rule number 1 is upheld, even if your initial thesis turns out wrong. Rule number 1, never losing money, is only achievable through the combination of the Circle of Competence and the margin of safety. The frantic, casino-style speculator is playing a losing game. Wealth is built by prioritizing structural survival over temporary surges. Mastering this defensive hierarchy is the exact mechanism that separates the average retail trader from the world's billionaires. By systematically removing the possibility of catastrophic loss, you allow compounding interest to operate without the resets that destroy average portfolios. If this video inspired you, smash that like button right now. Subscribe for more investing wisdom every single week. Comment below, which Buffett rule hit you the hardest today? Rule number 1, Circle of Competence, margin of safety? Tell me below. I read every single comment. See you in the next video.